Bitcoin above $80,000. Is the crypto fever coming back? There is a number Bitcoin investors have been waiting to see again: $80,000. And now it has happened. On August 25th, 2026, Bitcoin pushed above $80,000 and briefly traded above 81,000, reaching its highest level since May. Site Turn News Turn Search 11. But here is the question almost nobody should ignore. Is this the begin? Or is this simply another powerful rally before the market turns around and punishes late buyers? Because Bitcoin has done this before. It gets quiet. People lose interest. The headlines disappear. Investors decide the crypto boom is over. Then, suddenly, Bitcoin starts moving again. And when the price begins accelerating, everyone asks the same question: should I buy now? But that may be the wrong question. The more important question is this: what is actually driving Bitcoin above $80,000? Because if we understand what is behind this move, we can understand whether this is the beginning of something much bigger, or simply another temporary burst of excitement. And there is one detail about this rally that makes the current situation very different from the Bitcoin story most people remember. Let's start there. Bitcoin did not climb back above $80,000 because one single event suddenly changed everything. Instead, several forces began moving in the same direction. The dollar weakened. Investors became increasingly concerned about currency debasement. The bond market became a source of uncertainty. Regulatory expectations around cryptocurrency improved. And, importantly, money began flowing back toward Bitcoin investment products. That combination matters, because Bitcoin is not traded in a vacuum. Its price is connected to liquidity. It is connected to investor psychology. It is connected to interest rates. It is connected to the dollar. It's connected to regulation. And increasingly, it is connected to institutional capital. That last part may be one of the biggest changes in the Bitcoin market. A decade ago, Bitcoin was mostly a story about early adopters, technology enthusiasts, online communities, and speculative retail traders. Today, the market is much larger. Professional investors can gain Bitcoin exposure through regulated financial products. Large companies can hold Bitcoin, financial institutions can build businesses around digital assets, and governments can influence the environment in which the entire industry operates. That changes the game. But it does not eliminate risk. In fact, it may create a completely different kind of Bitcoin cycle. To understand why, we need to go back to the basic question: why does Bitcoin move so violently in the first place? Bitcoin has something traditional currencies do not have: a hard-coded maximum supply. There will never be more than 21 million Bitcoin. That scarcity is one of the central ideas behind the asset. But scarcity alone does not create a rising price. A rare object is valuable only when people want it. And that is where Bitcoin becomes fascinating. The Bitcoin story is ultimately a story about demand. When demand is weak, scarcity does not matter much. When demand suddenly increases, a limited supply can create explosive price movements. Imagine a small market with a limited number of sellers. If only a few buyers arrive, nothing dramatic happens. But imagine thousands of new buyers arriving at the same time. Suddenly, every seller has more negotiating power. Prices begin moving higher. Then other people notice. They see Bitcoin rising. They begin buying because they do not want to miss the move. The price rises again. More people notice, more buyers enter, and eventually, price itself becomes the advertisement. This is one of the most powerful forces in financial markets. Momentum creates attention. Attention creates demand. Demand creates momentum. And that cycle can continue much longer than most people expect. But there is another side. The same mechanism works in reverse. If Bitcoin starts falling sharply, attention can turn into fear. Fear creates selling. Selling creates more falling prices. Falling prices create more fear. And suddenly, the same market that looked unstoppable a few weeks earlier looks completely broken. This is why Bitcoin can rise thousands of dollars in a short period of time and then erase a large portion of those gains just as quickly. So when Bitcoin crosses $80,000, the important question is not simply how high can it go? The important question is how strong is the demand underneath the price? Because a price can move higher for several reasons. One reason is speculation. Another is genuine long-term demand. Another is short sellers being forced to close positions. Another is investors moving money into Bitcoin because they are worried about traditional currencies. And another is simply momentum. These forces can look identical on a price chart, but they have very different consequences. That is why this rally deserves a closer look. First, let's talk about the dollar. Bitcoin has increasingly become part of the global conversation about monetary value. When investors become concerned that the purchasing power of traditional currencies could decline, some begin searching for alternative assets. Gold has played that role for centuries. Bitcoin is attempting to play a similar role in the digital economy. That does not mean Bitcoin is guaranteed to behave like gold. It does not. Bitcoin is much younger, it is much more volatile, and its historical relationship with inflation is complicated. But investor psychology matters. If people begin to believe that governments and central banks will tolerate weaker currencies or easier financial conditions, assets with limited supply can become more attractive. And that is exactly the type of environment Bitcoin investors watch. Recent market coverage has linked the latest move above $80,000 to a weaker US dollar, concerns about currency debasement, and developments in the US Treasury market. Cite Turn News 34 Turn Search E11M. Think about what that means. Bitcoin does not need everyone to suddenly enough investors to decide that holding some Bitcoin makes sense. When that happens at scale, the effect can become significant. And there is another important factor: regulation. For years, one of the biggest questions surrounding cryptocurrency was simple: what happens when governments decide exactly how this industry should operate? Uncertainty creates hesitation. Large institutions do not like entering markets when the rules are unclear. They want to know what they are allowed to do. They want to know how assets are classified. They want to know what regulations apply. They want to know what happens if something goes wrong. Clearer rules can reduce some of that uncertainty. And recently, expectations for clearer US cryptocurrency regulation have helped improve market sentiment. Reuters reported that Bitcoin had risen 16% since President Donald Trump called for Congress to pass legislation providing clearer definitions for the cryptocurrency sector. Cite Turn Search 11. But here's where things become interesting. Better regulation can be bullish for Beyond, can also create new risks. Because once an industry becomes more institutionalized, it becomes more connected to the traditional financial system. Bitcoin becomes less isolated. And that can be good when money is flowing in, but it can become painful when institutions decide to reduce risk. This is one of the biggest changes in the modern Bitcoin market. Bitcoin is no longer simply an internet phenomenon. It is increasingly becoming part of a much larger financial ecosystem. That brings us to one of the most important developments of all: exchange-traded funds. For many investors, buying Bitcoin directly can feel complicated. There are wallets, private keys, exchanges, security concerns, custody, tax questions, operational risk. Financial products that provide Bitcoin exposure can make the process much simpler. And when large pools of capital can gain exposure through familiar investment structures, the potential pool of buyers becomes much larger. That does not guarantee higher prices, but it changes the demand structure. Instead of asking whether millions of individual people will suddenly create crypto wallets, we can ask whether large pools of capital will continue allocating money toward Bitcoin exposure. That is a very different question. And current market data suggests Bitcoin investment product flows have become an important part of the current recovery. Investopedia reported that Bitcoin ETFs had 5 consecutive days of inflows totaling nearly $2 billion in the period leading into this rally, although the products remained in net outflow territory for the year. Cite Turn News 38. That detail is important because it tells us something subtle. The market can improang being perfect. The rally does not require every investor to suddenly become bullish. It simply requires the balance between buyers and sellers to shift. If sellers become exhausted and buyers become more aggressive, price can move dramatically. This is why Bitcoin can spend months looking weak and then suddenly move 20% in a matter of days. The underlying market structure changes, and once momentum appears, traders react to it. But now we reach the biggest psychological question. What happens after $80,000? Because round numbers matter. They are psychological landmarks. $50,000 matters, $60,000 matters, $70,000 matters, and $80,000 matters. Not because the Bitcoin network knows what those numbers mean. The network does not care. Humans care, traders care, headlines care, social media cares. And investors create narratives around these levels. When Bitcoin breaks above a major psychological level, people who were waiting for confirmation may finally enter. At the same time, short sellers can be forced to close positions. That creates additional buying pressure. Then, momentum traders arrive. Then, financial media starts talking about Bitcoin again. Then, people who sold months earlier begin asking whether they made a mistake. And suddenly, the market has something extremely powerful: FOMO, fear of missing out. This is where a rally can become a frenzy. You've probably seen this movie before. Bitcoin rises. People start posting screenshots of their profits. Someone says Bitcoin is going to $100,000. Another person says $150,000. Someone else says 1 million. The conversation changes from risk management to dreams. People stop asking what could go wrong. They start asking how much they could make. That is usually when investors need to become more careful. Because enthusiasm is not evidence. A rising price does not prove that an asset is undervalued. It proves that buyers are currently willing to pay more. Those are two completely different things. And this brings us to a number that deserves attention. Bitcoin's previous all-time high was around $126,200 in October 2025. Cite turn search 7 times. So even after crossing $80,000, Bitcoin would still need a substantial move to return $80,000 to $100,000 is a 25% increase. From $80,000 to $120,000 is a 50% increase. That may sound huge, but Bitcoin has historically made moves of that size. The problem is that Bitcoin has also made moves in the opposite direction. This is the part new investors often forget. A 25% gain can happen quickly. A 25% loss can happen quickly too. And when leverage enters the market, movements can become even more violent. Imagine someone buys Bitcoin with borrowed money. Bitcoin rises. Their account looks fantastic. They become more confident, so they increase their position. Then Bitcoin falls 10%. Suddenly, the position is under pressure. The trader is forced to reduce exposure. Thousands of traders may be doing the same thing at once. Selling accelerates, and a normal correction becomes a much larger decline. This is why Bitcoin's volatility cannot simply be dismissed as noise. Volatility is part of the asset, it is part of the opportunity, and it is part of the risk. Now let's ask the question everyone really wants answered. Could Bitcoin reach $100,000 again? Yes. Is it guaranteed? Absolutely not. The difference between those two statements is where responsible analysis begins. There are reasons to believe the market could continue higher. The first is momentum. Bitcoin has moved from the high $60,000 and $70,000 area toward $80,000 in a remarkably short period. Current market reports describe the August move as one of Bitcoin's strongest monthly rallies in years, with gains around 28% so far in the month. Site turn news 34 turn search. The second is institutional demand. If investment product flows remain persistent source of buying pressure. The third is regulation. If the United States moves toward clearer rules for digital assets, institutional participation could become easier. The fourth is the macro environment. If investors continue worrying about the purchasing power of fiat currencies, scarce assets could remain attractive. And the fifth is psychology. Once Bitcoin starts approaching major levels again, the amount of attention it receives can increase dramatically. But there are also serious reasons to be cautious. Bitcoin is still extremely volatile. Inflation remains a concern. Interest rate expectations can change. Geopolitical events can trigger risk-off behavior. Regulatory developments can disappoint investors. ETF flows can reverse. And perhaps most importantly, Bitcoin has already experienced a huge move. When an asset rises rapidly, early buyers often have an incentive to take profits. That creates resistance. Think about an investor who bought Bitcoin at $60,000. At $80,000, they are sitting on a large gain. They may decide to sell. Now imagine thousands of investors doing the same thing. That creates a natural supply wall. So the same rally that attracts buyers can also attract sellers. This is why markets rarely move in a straight line. Every new high creates a new group of people who want to sell. Every correction creates a new group of people who want to buy. The battle between those two groups determines the next move. And this brings us to the most important question of this entire video. What would prove that the Bitcoin comeback is real? Not a single green candle, not one day above $80,000, not a viral video, not a celebrity prediction, and not a random price target on social media. A stronger signal would be sustained demand. If Bitcoin can hold higher levels after the initial excitement fades, if investment product inflows remain healthy, if institutional participation continues, if regulatory clarity improves, and if the broader macro environment remains supportive, then the case for a sustained recovery becomes stronger. But if Bitcoin quickly falls back below major support levels, if demand dries up, if investors begin pulling money from Bitcoin products, or if the macro environment turns sharply against risk assets, then the $80,000 breakout could turn into a bull trap. And a bull trap is one of the most dangerous situations for inexperienced investors. Because it looks like confirmation. The chart breaks higher, everyone becomes excited, people buy. Then the market reverses, and the people who arrived late become the people selling in panic. This is why professional investors often care less about predicting the exact top and more about managing what happens if their prediction is wrong. That mindset is very different. A beginner asks, "How much can I make?" A disciplined investor asks, "What happens if I am wrong?" That one question can change everything. Now, there is another reason this Bitcoin rally is interesting. Bitcoin's story is no longer just about Bitcoin. When Bitcoin moves strongly, the rest of the crypto market often reacts. Ethereum can move, Solana can move, crypto-related stocks can move, smaller tokens can suddenly attract attention, and this is where the crypto fever can become much larger than Bitcoin itself. At the beginning of a rally, investors may focus on Bitcoin because it is the largest and most established cryptocurrency. But once Bitcoin rises far enough, investors often begin searching for higher returns elsewhere. They move down the risk curve. Bitcoin first, then large cryptocurrencies, then smaller projects, then speculative tokens, and eventually sometimes almost anything with a ticker starts rising. That is when a market can become euphoric, and that is also when risk can become extreme. We saw versions of this behavior during previous crypto cycles. At first, investors talked about technology, then they talked about adoption, then they talked about price, then they talked about getting rich. And eventually, the market became less about fundamentals and more about momentum. That is the cycle investors need to recognize, because the beginning of a crypto boom can look intelligent, the middle can look inevitable, and the end can look completely irrational. The challenge is knowing where you are. So where are we now? That is the difficult part. Bitcoin above $80,000 is clearly significant, but it does not automatically mean a new bull market has begun. Even analysts discussing the current move have warned that it is still early to determine whether the rally will develop into a sustained bull market. Site turn search 14, and that uncertainty is healthy. Markets need uncertainty. If everyone already knew $150,000, the market would price that expectation immediately. Prices move because people disagree. Some investors believe Bitcoin is cheap. Others believe it is expensive. Some believe the dollar is weakening. Others believe that weakness is temporary. Some expect regulation to unlock institutional demand. Others expect regulation to create restrictions. Some see Bitcoin as digital gold. Others see it as a speculative asset. And every trade is effectively a disagreement between two sides. The buyer says, "I believe the future value will be higher." The seller says, "I believe this price is attractive enough to exit." Both cannot be right about the future. And that is why price alone cannot tell us the entire story. We need to understand the forces behind it. Let's step back even further. Why does Bitcoin matter at all? At its core, Bitcoin introduced an unusual idea. A digital asset could exist without being controlled by a central government or a traditional financial institution. Its supply could be limited by code. Its network could operate globally. Transactions could occur without requiring the same intermediaries used by traditional financial systems. That idea has survived for more than a decade, but survival is not the same as success. Bitcoin still has to prove that people will continue wanting it. And the market is effectively running that experiment every day. Every buyer is making a bet that Bitcoin will remain relevant. Every institution allocating capital is making a bet that digital assets will continue becoming part of the financial system. Every government creating rules is influencing the future of that ecosystem, and every crash tests the conviction of investors. This is why Bitcoin's history is so important. The asset has survived enormous drawdowns. It has survived skepticism. It has survived exchange failures. It has survived regulatory attacks. It has survived periods when the mainstream media declared the entire crypto industry finished. And yet it kept coming back. That does not prove Bitcoin will continue rising forever. Nothing rises forever. But it does demonstrate something important. The network has developed an extraordinary ability to remain relevant, and relevance is one of the most valuable assets in a speculative market. Now consider the psychology of today's investor. Someone who bought Bitcoin near the previous highs may still remember the pain of the decline. They may be thinking, I am finally getting close to break even. That person may sell. Another investor may have watched Bitcoin fall and waited for a confirmation signal. For them, $80,000 may be the confirmation they were waiting for. They may buy. A third investor may have bought much lower. For them, $80,000 may be an opportunity to take profits. And a fourth investor may not own Bitcoin at all. They may see the headlines and think, I am missing out. Those four people create four completely different behaviors. And that is what makes the market so unpredictable. Price is not just mathematics. Price is psychology. Now imagine Bitcoin reaches $90,000. The headlines become even louder. Then $95,000. People start talking about $100,000. And once $100,000 gets close, something interesting happens. The number becomes symbolic. It is no longer just a price. It becomes a story. Bitcoin at $100,000 would become a headline. It would become a social media event. It would become a psychological milestone. And that attention could attract even more capital. But it could also attract more profit-taking. That is why major round numbers often produce intense battles between buyers and sellers. So if Bitcoin reaches $100,000, do not assume the journey becomes easier. It could become harder because expectations become higher. And when expectations are high, disappointment becomes more powerful. This is true in every market. If investors expect 5% growth and receive 8%, they are happy. If investors expect 30% growth and receive 8%, they may become disappointed. Bitcoin is no different. The higher expectations rise, the more perfect the future needs to look. And perfection is difficult. So what could derail the current Bitcoin recovery? Let's look at 5 major risks. Risk number 1, a stronger dollar. If the dollar strengthens significantly, some investors may become less interested in alternative assets. Risk number 2, tighter financial conditions. If borrowing costs rise or liquidity falls, speculative assets can come under pressure. Risk number 3, regulatory disappointment. If expected crypto legislation fails or creates restrictions investors dislike, sentiment could reverse. Risk number 4, ETF outflows. If institutional investment products begin experiencing sustained withdrawals, that could remove an important source of demand. And risk number 5, pure exhaustion. Sometimes a market simply moves too far too quickly. When Bitcoin gains roughly 20% or more in a short period, some traders may decide the easy money has already been made. That can trigger a correction even without a major negative headline. This is why a correction would not necessarily mean Bitcoin is finished. A correction can simply be the market breathing. The danger comes when investors interpret every correction as either the end of the world or a guaranteed buying opportunity. Both extremes can be dangerous. Markets require flexibility. Now let's talk about the opposite scenario. What if Bitcoin does continue higher? What happens then? The first major psychological target would likely be the area around $90,000, then $100,000, then the previous record zone around $126,000. But price targets should not be treated like destinations on a map. Markets do not know where analysts want them to go. They move based on supply and demand. If demand becomes extremely strong, Bitcoin could move faster than expected. If demand weakens, it could stall far below those levels. This is why anyone watching Bitcoin needs to pay attention to behavior rather than predictions. Watch what buyers do after a pullback. Watch what happens when the price reaches resistance. Watch whether demand remains strong after the headlines disappear. Watch whether institutional flows remain positive. Watch whether the broader financial environment supports risk-taking. And watch sentiment, because sentiment often tells you when a market is becoming dangerous. When everyone is terrified, opportunity can appear. When everyone is euphoric, risk can increase. That does not mean you should automatically buy fear or sell excitement. But it means you should understand the psychology surrounding the price. Now let's imagine two futures. In the first future, Bitcoin holds above $80,000. Institutional demand continues. Regulatory clarity improves. The dollar remains relatively weak. Liquidity becomes more supportive. Investors regain confidence. Bitcoin moves toward $90,000, then $100,000. The crypto market becomes increasingly active. Media coverage explodes. Retail investors return. Altcoins begin outperforming. The cycle feeds itself. That is the bullish scenario. But now imagine the second future. Bitcoin breaks above $80,000. Everyone becomes excited. Then ETF inflows weaken. The dollar strengthens. Bond yields rise. Investors become concerned about inflation. Risk appetite falls. Bitcoin drops below 80,000, then 75,000. The people who bought during the excitement begin selling. Leverage gets liquidated. The decline accelerates. Suddenly, the same people who were predicting $150,000 are predicting $50,000. That is the bearish scenario. Which one will happen? Nobody knows. And anyone claiming absolute certainty is selling confidence, not analysis. The better question is, which signals would make one scenario more likely than the other? That is how investors should think, not in certainties, in probabilities. Right now, Bitcoin has demonstrated that buyers are willing to push it above $80,000. That is meaningful. But the next test is whether buyers can defend those levels. A breakout is one thing. A sustained breakout is another. And that distinction could determine whether this is simply a recovery rally or the early stage of another major crypto cycle. There is also something else worth watching: the relationship between Bitcoin and the broader economy. For years, Bitcoin was often described as an independent alternative financial system. But as institutional participation grows, Bitcoin becomes more sensitive to traditional market conditions. If investors are comfortable taking risk, Bitcoin can benefit. If investors are reducing risk across portfolios, Bitcoin can suffer. That means Bitcoin's future may increasingly depend on forces that have nothing to do with blockchain technology. Interest rates, government spending, bond markets, currency strength, liquidity, regulation, institutional portfolio allocation. This may sound boring compared with watching a Bitcoin price chart, but these forces can be more important than the chart itself, because the chart tells you what happened. The macro environment can help explain why. And that leads to another important lesson. Bitcoin is not only a technology story. It is not only a monetary story. It is not only a speculative story. It is all three. And depending on the moment, one story can dominate the others. During a technology boom, investors focus on adoption. During monetary uncertainty, they focus on scarcity. During a speculative frenzy, they focus on price. Right now, all three narratives are colliding. That is one reason the market feels so interesting. Bitcoin is becoming relevant again at exactly the moment when investors are questioning the stability of traditional financial systems. But relevance does not equal certainty, and scarcity does not equal guaranteed appreciation. This is the line every investor needs to understand. Bitcoin can be revolutionary and still be risky. Bitcoin can have strong long-term demand and still fall 30%. Bitcoin can attract institutions and still experience massive volatility. Bitcoin can eventually reach new highs and still make terrible short-term investments for someone who buys at the wrong moment. These statements can all be true at the same time. And that is why responsible investing is not about choosing between Bitcoin is amazing and Bitcoin is a scam. The real world is more complicated. Now let's look at the people who are most vulnerable during a crypto boom. They are not necessarily the people who know the least about Bitcoin. Sometimes they are the people who know just enough to become overconfident. They hear that Bitcoin is above $80,000. They hear that it could reach $100,000. They see someone making money. They deposit money. They buy. Then Bitcoin falls. Instead of having a plan, they panic. They sell. Bitcoin recovers. They buy again. Then it falls again. This cycle can destroy returns even if Bitcoin itself eventually rises. Why? Because emotions cause investors to buy high and sell low. The asset may perform well. The investor may still lose. That is one of the strangest realities of markets. A good asset does not automatically create a good investment decision. Timing matters, position size matters, risk tolerance matters, and expectations matter. If someone cannot emotionally handle a 30% drawdown, then owning an asset capable of falling 30% is a problem regardless of the long-term thesis. That is why Bitcoin's return potential and Bitcoin's risk cannot be separated. You get the opportunity because you accept the volatility. There is no free version. Now let's return to that $80,000 number. Why does it feel so important? Because Bitcoin has spent months below it. Crossing above it changes the narrative. Yesterday, people could say, Bitcoin is still recovering. Today, they can say, Bitcoin is back above $80,000. Those two sentences create completely different emotions. One sounds uncertain, the other sounds powerful. And markets are heavily influenced by language. The headlines change, the social media conversation changes, the perception changes, and perception can influence behavior. This is why price levels matter psychologically, even when they have no fundamental meaning. A Bitcoin does not become more useful because it is worth $80,000 instead of $79,000. But investors may behave differently, and behavior moves markets. So perhaps the most important question is not whether Bitcoin is expensive or cheap. It is whether the current demand is strong enough to absorb the sellers who are waiting above. That is the battle. Buyers want continuation. Sellers want to take profits. Short sellers want a reversal. Momentum traders want confirmation. Long-term investors want adoption. Institutions want exposure without unnecessary risk. And regulators want control and clarity. All of those forces are interacting simultaneously. That is why predicting Bitcoin with one simple indicator is almost impossible. You need to look at the whole system. Price, volume, flows, liquidity, regulation, macro conditions, sentiment, and time. Now imagine you are watching Bitcoin on your screen. The price moves from $80,000 to $82,000. You feel excitement. Then it falls to $79,000. You feel fear. Then it rises to $83,000. You feel relief. Then it falls to $77,000. You feel panic. Nothing about the Bitcoin network changed during those hours. The code did not suddenly become better. The number of maximum Bitcoin did not change. The underlying protocol did not transform. What changed was the price people were willing to pay. This is an important lesson. Short-term Bitcoin trading is largely a battle of expectations. Long-term Bitcoin investing is a battle of conviction. Those are not the same thing. If you are trading, you need a plan for volatility. If you are investing, you need a thesis that can survive volatility. Confusing the two can be expensive. And this is where the current rally becomes especially interesting. Bitcoin is showing strength, but strength creates a new challenge. It must prove that the move can survive after the excitement fades. The first wave of buyers can push a price higher. The second wave determines whether the move lasts. The third wave can determine whether a new cycle begins. So the next few stages of this market may tell us much more than the first breakout above $80,000. If Bitcoin holds the level, that is information. If it retests the level and buyers step in, that is stronger information. If it falls below it and quickly recovers, that is also information. If it breaks down and stays below, that tells a different story. The market is constantly giving signals. The challenge is learning to listen without becoming emotionally attached to one outcome. Because Bitcoin does not care what you believe. The market does not care about your prediction. And the chart does not care about your hopes. It simply reflects the ongoing battle between buyers and sellers. That is why the smartest approach is not to predict the future with absolute confidence. It is to prepare for multiple futures. Bitcoin could continue higher. Bitcoin could consolidate. Bitcoin could correct. Bitcoin could eventually make a new all-time high. Bitcoin could also disappoint investors again. Every one of those outcomes is possible. And the probability of each one changes every day. So what should we watch from here? First, whether Bitcoin can remain above the $80,000 region. Second, whether institutional flows remain supportive. Third, whether regulatory developments continue improving market confidence. Fourth, what happens to the US dollar? Fifth, what happens in bond markets? And sixth, whether retail excitement begins turning into outright speculation. That last signal may be particularly useful because there is a difference between renewed interest and mania. Renewed interest is healthy. People start researching Bitcoin again. Institutions begin allocating capital. Developers continue building. Regulators create clearer rules. Investors consider Bitcoin as part of diversified portfolios. Mania looks different. People borrow money to buy. People sell everything to chase the market. People buy tokens they cannot explain. People believe prices can only go up. People stop discussing risk. And when those behaviors become widespread, the market can become extremely fragile. We are not there simply because Bitcoin crossed $80,000, but it is something worth watching. Because Bitcoin's most powerful rallies often begin with skepticism and end with euphoria. The transition between those two states is where fortunes are made and lost. And perhaps that is the real story behind Bitcoin crossing $80,000. It is not simply a number. It is a test of demand, a test of investor confidence, a test of institutional participation, a test of the broader financial environment, and a test of whether the crypto market can rebuild the momentum it once had. Remember, Bitcoin has already shown that it can fall dramatically from previous highs. The all-time high around $126,200 in October 2025 is a reminder that even record-breaking prices can eventually be followed by deep corrections. Cite and search 17. So today's $80,000 rally should not be viewed in isolation. It sits inside a much L of excitement, fear, innovation, speculation, regulation, institutional adoption, and human psychology. That cycle is not new, but the players are changing. The market is becoming more institutional. The infrastructure is becoming more sophisticated, and Bitcoin is becoming more integrated into mainstream finance. That could make future cycles different from the ones we saw years ago. It could mean deeper liquidity. It could mean broader adoption. It could mean less dependence on retail speculation. But it could also mean greater sensitivity to global financial conditions. The old Bitcoin market was largely its own world. The new Bitcoin market is increasingly connected to everyone else's. And that may be the biggest story hiding behind the $80,000 headline. Bitcoin is no longer just a cryptocurrency story. It is becoming a story about money itself. What should money look like? Who should control it? How scarce should it be? How should digital ownership work? How much trust should people place in governments, banks, technology, or code? Bitcoin does not provide simple answers to all those questions, but it forces the world to ask them. And that is one reason it refuses to disappear. So, is the crypto fever coming back? The answer may be yes, but not necessarily in the way people remember. The next crypto cycle may not begin with everyone suddenly buying Bitcoin from their phones. It may begin quietly, with institutions increasing exposure, with financial products attracting capital, with regulators providing clearer rules, with investors looking for alternatives, with Bitcoin slowly becoming normal. And then, if the price keeps rising, the public may notice. That is when the real test begins, because the market can move from cautious interest to full-blown speculation incredibly quickly. And once everyone is talking about Bitcoin again, the question will no longer be whether the crypto fever is returning. It will be whether the fever has gone too far. That is the difference between the beginning of a cycle and the end of one. For now, Bitcoin has crossed $80,000. It has reclaimed a level that seemed far away during the recent weakness. It has attracted attention again. It has brought institutional flows back into the conversation. It has benefited from a weaker dollar and renewed interest in cryptocurrency regulation. And it has reminded the market of one simple truth. Bitcoin is very difficult to ignore when it starts moving. But do not confuse attention with certainty. The next chapter is still being written. Maybe Bitcoin pushes toward $90,000. Maybe it reaches $100,000. Maybe it eventually challenges the previous record near $126,000. Or maybe the market runs out of momentum and forces investors to wait again. Nobody knows. And that uncertainty is exactly what makes the market interesting. Because Bitcoin's biggest moves rarely happen when everyone agrees. They happen when expectations collide, fear meets greed, scarcity meets demand, technology meets finance, and investors decide how much they are willing to risk on the future. So if you are watching Bitcoin today, do not just watch the number. Watch what is happening underneath it. Watch the money. Watch the institutions. Watch the dollar. Watch regulation. Watch liquidity. Watch sentiment. And most importantly, watch what happens when the excitement disappears, because that is when we will learn whether Bitcoin really has entered a new era, or whether $80,000 was simply another stop on a much more complicated journey. And if the next major move is coming, the most important clue may not be the price itself. It may be who is buying, why they are buying, and how long they are willing to hold. Bitcoin has crossed $80,000. The question is no longer whether the market can get there. The question is what happens next. Because if the buyers are real, if the demand is sustainable, if institutions keep returning, if the macro environment remains supportive, and if regulation continues moving toward clarity, then $80,000 may eventually look less like the destination and more like the starting line. But if the demand disappears, if liquidity tightens, if investors become afraid, and if the breakout fails, then this rally could become another lesson in why Bitcoin never rewards blind confidence for long. That is the paradox of Bitcoin. The same volatility that creates extraordinary opportunity also creates extraordinary danger. And that is why the smartest people in the market are not asking, will Bitcoin go up? They are asking, what would have to happen for Bitcoin to keep going up? And what would prove that the thesis is wrong? Those are better questions, because markets are not about being right every time. They are about surviving the times you are wrong. Bitcoin's return above $80,000 has reopened the conversation. The bulls are back. The institutions are watching. Retail investors are paying attention again, and the crypto market is waking up. But whether this becomes another speculative frenzy or the beginning of a more mature Bitcoin era will be determined by what happens next. The number on the screen is $80,000. The real story is everything underneath it. And the next move could tell us whether Bitcoin is simply recovering or whether another crypto cycle has truly begun. Bạn muốn bản tiếp theo hướng giật mạnh kiểu viral, phân tích tài chính chuyên sâu hay kể chuyện cinematic?